Okay, hey everyone. My name's Nick Hope. I'm a co-founder of Talarion, and we are the world's first information marketplace. So if there's something that you know that we don't, please come tell us, and we will pay you for it. But I'm not really here today to talk about our company. I'm here to give a fun and brief talk about information theory. So what is information? How should we quantify it? When does it matter if you're wrong? Let's get started. So what is information? People at this conference have talked a lot about its value. People who care about prediction markets care about information. They care about being correct. So how should we measure information? Well, Claude, and I mean Claude Shannon, although Claude could also tell you this, came up with a reasonably good definition. He thought about information in terms of surprise. So Shannon's surprisal is the logarithm of the reciprocal of the probability of an event, or equivalently, the negative logarithm of the probability. This says the more surprising something is, well, the less probable it was. And from the surprisal, we can measure the irreducible uncertainty associated with a random variable. This is exactly the Shannon entropy. So if I have a perfect probabilistic model of the world, the Shannon entropy H is my expected surprise associated with a random variable x. So, as everyone here probably knows, bad models make the world more surprising. How do they do that? Well, your expected surprise when you observe some realization of a random variable depends on your model for the world. In other words, how likely you thought the various outcomes were. And so, if you have a model Q, but the real model is P, then you're going to be more surprised than you otherwise might have been. And so this quantity is referred to as the cross entropy. So the cross entropy of two distributions, P and Q, is given by the negative sum of P log Q. So your surprisal is coming from the distribution Q, because that's how you modeled the world, but the weighting in your sum, or if we're talking about a continuous random variable, the weighting in your integral is coming from the distribution P, because this is what's actually true about the world. So what can we do? We can take the difference between the cross entropy, so your expected surprise under a model Q, and the irreducible uncertainty H associated with the true variable P. What this gives you is the Kullback-Leibler divergence, or the KL divergence. This is specifically how much more surprised you are due to how wrong your model is. Note that this isn't a symmetric quantity, by the way. So the KL divergence associated with from P to Q is not the KL divergence from Q to P. So, okay, let's take it back to prediction markets. Suppose a market is trading at a price Q, and I correct it to a price P. How much is that worth? Well, clearly, it's not just worth the arithmetic difference between P and Q. If I take a market that was trading at 50 cents and I correct it to 52 cents, I haven't accomplished much. If I take a market that was trading at 97 cents and trade it to 99 cents, well, in a sense, I've made that market 3 times as certain as the likely outcome. How can I be more systematic about that measurement? Well, way back in 2002, before I was born, as were I'm sure some of the other people in this room, Robin Hanson had a pretty good idea. For those familiar with Uniswap, this is an automated market maker variant proposed for prediction markets. So in the simple binary case, this reduces to the following. The marginal price of a contract under a logarithmic market scoring rule is given by e to the x over 1 plus e to the x, for x, the signed quantity of contracts traded by the taker. So as you can probably tell, as x moves towards infinity, so people are buying and buying and buying a given contract from the AMM, you will asymptotically approach a price of 1. And similarly, if people are selling into an AMM, you will asymptotically approach a price of 0. The nice thing about this is that similar to a Uniswap curve or any other constant function AMM, you can offer unlimited liquidity with a horizontally capped total loss for the market maker. So under the LMSR, we have a very, very nice property, which is that if I want to move from a market price Q to a fair price P, well, I'll purchase the number of contracts delta. This is up to some absolute scalar that defines the characteristic size of the market. My total cost I can get from integrating the marginal price from that initial price Q to the final price P. And my expected P&L, and note expected, because in my realized P&L depends on the actual resolution of the market, will be given by the fair price P times the number of contracts that I purchased delta minus the cost that I paid for them. And the really nice thing about this quantity is it is exactly equal to the KL divergence of P given Q. In other words, the expected profit that a trader can gain when trading on an LMSR from an incorrect price Q to a final fair price P is exactly the KL divergence. So what can we do with this? Well, let's talk about when it's worth paying to confirm your prior. So I want to walk you guys through a simple thought experiment. Suppose you visit your family doctor, and they estimate that you have a 20% chance of suffering from some rare condition, but your doctor indicates to you that she's really not sure. She's no expert. Then you go to a specialist. That specialist consults the available data, and it turns out that for people from your demographic, maybe with your observed symptoms, exactly 20% of them suffered from this condition. So, have you gained any valuable information? Robin Hanson might argue no, right? You paid to see a specialist. All the specialist did was confirm your prior. Yet I would guess that you do feel like you've learned something. So uncertainty in the value of P itself, in other words, uncertainty as to how accurate a prediction market really is, should not change the behavior of a rational decision maker. But does that really feel right? I think a lot of people in this room would recognize that when they formulate a prior on a given question, they care not just what that prior is, right? Not just how high entropy that prior is, but they also care about how certain they feel in their own prior. The flip of a fair coin is a maximum entropy event, and yet, if I know that the coin is fair, I feel quite confident in my characterization. So, when is uncertainty about a prior a useful thing? Well, confidence feels good, and there are at least 3 different sort of qualitatively distinct cases in which you can actually prove mathematically that you're glad you reduced the uncertainty in your own prior. So the first case is the case in which there might exist a better prior than yours. And there's nothing market makers are more afraid of, or maybe even geopolitical strategists for that matter, than knowing that they are participating in a multiplayer game where other participants may have a confident, different, and correct prior. If I'm a market maker and I know that I'm making a market on the outcome of a fair coin, or a fair die for that matter, I will happily quote a deep and tight market. This is not the case if I do not know the true probability of the coin that is being flipped, and there's a possibility that the counterparty does. Second is the case of multiple correlated outcomes. So you can imagine if I have a single coin and the expected probability of heads is a half, well, any uncertainty over P will not affect the variance of a single coin flip. If I'm going to flip that coin repeatedly, though, this becomes untrue. The variance of multiple flips of a fixed coin does absolutely depend on uncertainty over the prior. Lastly, there's the case of expected information. So I think a lot of people here, if they were told that they had a 20% chance of suffering from some rare disease, and they could go confirm that from an expert, would choose to do so. Why? Because they're receiving a signal with positive expected informational value, even though the realized informational value might be 0. In other words, your family doctor presumably believes that the expected prior of the specialist is 20%, but that may not be their realized prior. Cool. That's all I got. Any questions? Yeah, please. Dan, yeah, what's up? Mm-hmm. Yep, that's right. Yeah, so like in the prior sort of thought experiment, the random variable is like, do you have the condition? And the question is like, when should you pay to confirm somebody else's prior on whether or not you have the condition? Right? And like, the claim would be that even if like the uncertainty over the prior P does not matter for a rational decision maker. Like telling you that like I have some distribution over possible priors with expectation P, or that like I can tell you with absolute confidence and zero sort of second order uncertainty that the prior is P, like it does not matter for a rational decision maker that only cares about this one outcome. Yep. Yep. Mm-hmm. No, good question. Yeah, sorry. So maybe what I should have said at the beginning is this is all motivated by a desire to quantify the value of information, specifically from the perspective of a buyer. And so like one way of thinking about the value of information is, well, how far apart are two priors, right? And there the claim is the correct answer is KL divergence. But then you have the question of like, okay, when should I pay just to confirm my prior? In other words, if you're an expert and I'm not, right, and it turns out you share my prior, should I still have paid you to tell me that? And if so, how? And so like here the claim would be, if you go to Polymarket and Polymarket confirms there is like a 20% chance that you have the condition, was this valuable? Now obviously a trader that knows it couldn't have made any money off of that insight on an LMSR. And so the interesting thing to think about is like, all right, what are the set of distinct circumstances in which second order uncertainty, like as in uncertainty over the prior, does actually matter? And so then like, I would claim these are like three different like semantically distinct cases in which it probably does. There's like the market maker case where it's like, okay, I have my fare, but depending on how confident I am in my fare, I'm willing to like quote a deeper market. There's the case where like, there's the thing you think you care about, but actually you care about like a bunch of correlated things. And so like the variance over a set of correlated outcomes like will absolutely depend on uncertainty over the prior, right? This is the like bunch of flips of a fixed coin example. And then lastly, there's the case in which like we just need to be careful we're not conflating the realized informational value of a signal, like ask Polymarket or ask an expert, with the expected informational value. So one model would be your family doctor is saying what they expect the specialist to say, but the specialist's opinion, which we're taking as the ground truth, is being drawn from a distribution centered at whatever the family doctor is saying, right? All the family doctor can say, and like, if the family doctor like knows what the specialist distribution looks like, the family doctor will always like guess mu. And so then you have positive expected informational value, even though like in the mean case, you don't get any. Do those three different cases make sense? Okay. Yep. Yep, perfect. Yeah. Mm-hmm. It's a great example. So I think I would say two things. One is like, if I had a prior that was not 34%, right, I could definitely say like, well, the KL divergence between my prior and 34%, that's something that I learned. But if I did have a prior that was 34%, did I learn anything from that? And my contention would be still yes. And in this case, you're in the multiplayer game case where it's like, if you're a business person thinking about doing a deal in Ukraine, what do you care about? You care about whether or not there are other participants that have better information than you, right? It is hard to do that business deal if you know that there are other people who may know better than you. So the claim would be paying for ground truth is helpful in the multiplayer case, even if it confirms your prior, because it lets you know that there is not an actor who knows that, say, there's a 98% chance that there will be a ceasefire. Mm-hmm. You totally are. Yeah, you totally are. I think the interesting thing is to think about like, okay, Definitely it's true that if you're paying an expert for ground truth and their prior is different from yours, that's valuable, and you can quantify exactly how valuable. But when you're paying for someone to confirm your prior, when is that valuable? Yeah. But you're absolutely right that like any prediction market, whether it's an order book or an LMSR, will reflect like a bunch of aggregated or essentially averaged beliefs on like a capital weighted average basis. And so there may well exist individual market participants that are undercapitalized but have like a high certainty prior different than the market prior. Oh, 100%. Yeah. Yeah, what's up? Yeah, please. Mm-hmm. Yep. Uh-huh. Mm-hmm. Okay. Yeah. It's a great question. Yeah. So the case in which we can prove that it does not matter, as in like second order uncertainty or uncertainty over your prior does not matter, is the case in which there are two different actions I can take, right? Well, actually, no, sorry. I mean, that's not even quite true. You can have as many actions as you want, but like you have a utility function that says, okay, there's some action that's the best action in the case where I don't have the disease, and there's another action that's the best action in the case in which I do have the disease, right? So any like optimal strategy will reduce to just those two actions, right? And then you're taking an expectation over the value of p. And so if you integrate over any distribution of possible values of p that has an average of p, is the law of total expectation, your optimal strategy will still be the optimal strategy in the case where the prior is just 20%. If that isn't an appropriate decision model, for instance, if there are multiple related things you care about, and so like your utility function actually takes a bunch of inputs, which are a bunch of different correlated random variables, and what you're actually trying to forecast on is some latent variable that affects all of them, then you're in a different situation, and you do care about second order uncertainty. Yeah. Uh-huh. It's a great question, and it's a really philosophically interesting question about like irreducible uncertainty, right? Like some things are like when I, Nicholas Hope, formulate priors, some of them are about things that will happen in the future, and other things could be like things that are true right now and are questions of subjective uncertainty for me rather than like absolute temporal uncertainty for everyone. In the context of this particular model, I guess what I'll say is the nice thing about the logarithmic market scoring rule is that it is path independent, meaning the marginal price depends only on the cumulative trading volume on the market. It does not depend on the order in which those trades occurred. Does that answer the question? Yeah, yeah, absolutely. Yeah, no, I mean, right. Like, I think a problem with LMSR is that you require a market maker to seed it, right? Now, their loss is bound by negative log p for p the probability they assign to the event that occurs, right? So if it's a thing that's going to happen, their loss is going to be negative log p for p their prior on how likely that thing is. And if they just like leave the market open and it expresses some continuous price as a function of time until the event occurs, they will like definitely lose that entire amount. And like this is unappealing for a liquidity provider. And so like, well, it is a reasonable model for somebody who wants to pay to get a given question answered, it is not a profitable model for the market maker. Okay. Yeah, totally. All right, well, I'm probably at time. But if anyone has one last question, happy to answer it. Otherwise, yeah, what's up? That's right. As in, LMSR is like the unique construction for which moving a price from Q to P provides an expected P&L equal to the KL divergence. That's right. Mm-hmm. You mean like if you're trading on some market microstructure that's like an order book and not an LMSR? Or? Yeah, well, it's interesting, right? I mean, so like, you know, P&L tends to be quadratic in difference between like current price and fair, right? Just because the P&L, like what you earn per contract traded is linear in that difference. It just is that difference. And then the liquidity available between two price points tends to be locally linear as well. So like, you know, like locally quadratic models for order books are fine, I guess. There's one. Sweet. All right, thanks everyone.